Welcome to Season 5 of the SARE Ladies Podcast. This is where Asian American Pacific Islander women carve out their own space in real estate and shake up the status quo. Join your hosts, Anita Wong and Ashley Cow, as they dive deep into bold strategies, personal growth, and everything it takes to own it. From building wealth to boosting confidence. Let's jump in. Well, welcome back to the SARE Ladies Podcast, where we talk real estate, representation, and rewriting the rules of wealth. I'm your host, Anita Wong, real estate investor, syndicator, and co-founder of Give Rise Capital.
And I'm Ashley Cow, commercial mortgage lender, investor, recovering tech employee, and your co-host.
So today we are here to break down a framework that is the thing that quietly powers how wealthy people build and protect the money. It's called the Wealth Trifecta. And in this three-part framework that wealthy people use, they do to reduce taxes, to protect assets, and build generational wealth. And today our guest helps clients do that every day.
Yes, our guest today is Ashley Burr. So we have an Ashley sandwich with Anita in the middle. She is a senior attorney at KKOS Lawyers and specializes in helping entrepreneurs and real estate investors build their wealth trifecta system. So aligning their business entities, investments, and trusts for maximum tax efficiency and asset protection. Ashley, welcome. We're excited to have you here.
Yes, thank you so much. I'm excited to be here. Thanks for having me.
Yeah. So before we jump into this trifecta, we kind of wanted to do some icebreaker with you and kind of get to know you a little bit more.
All right.
So the first question is, what is one financial rule you swear by?
I think my favorite financial rule would be invest early and consistently. So investing early and consistently, that's how you get rich, but you don't have to be rich to start investing. And you guys should all be investing as early as you can, because that's just going to build, that's going to compound. By the time you're at retirement age, you could have a lot of money sitting in your investment. So as early as you can. And like I said, you don't have to be rich to start investing. If you could throw $100 a month into a REIT or a debt fund or something that has some asset that has income producing benefits, just start with that. You'll get accustomed to never seeing that $100 again. And that's really how you start, is early and consistently.
Cool. Yeah. It's a muscle or a habit that you got to build over time, right?
Exactly.
So
Exactly.
what's the biggest money mistake people make?
I think ignoring retirement savings, being able to use your retirement to invest in things, that is tax-free growth that you're leaving on the table. Some people are really turned off by putting money into retirement because they say, hey, I can't even see any returns until I'm 59 and a half. But they miss the point where you need to be investing both outside retirement and inside. Outside, because you can get that immediate cash flow, but you want to be building up that tax-free growth at the same time. So I think that's the biggest mistake, is ignoring those retirement savings.
Yeah. What's a common wealth habit you see your wealthiest clients have?
Yeah, so all of my wealthy clients own real estate. They learn quick that benefit of real estate. And you don't have to be a landlord or a property manager. There are many ways that you can get into real estate. But yeah, maxing out retirement and investing in real estate, that is what all my wealthiest clients are doing.
Nice. All right. And then obviously you do a lot of estate planning. So what's one thing you're tired of answering in estate planning?
Yeah, am I too young to have an estate plan? That there's no such thing as being too young to have an estate plan. If you have cash in the bank, you have a house, you have kids, you need to have an estate plan. Just because we're talking estate plan or setting it up, it doesn't mean you're going to die sooner. And I know it's weird to plan for your death, but it's inevitable. Get it done now, because you don't know when that clock's going to stop ticking. You need to have that in place.
For sure. Yeah. Okay. And then what is one thing that clients misunderstand about your job?
Yeah, so I think when people assume attorney, they think I'm in, court system, litigation, and things like that. That's only one sort of attorney. I'm out here, I'm with clients, I'm helping them build their structure, but I don't need to go to court for them to help get that done. I'm looking at their structure and I'm making sure they're set up best for both asset protection and tax savings. So just because you're an attorney, it doesn't mean you're just doing the trial work. There are things that happen behind the court scenes that is also very important for your business and as an investor.
Yeah. Okay. Last one here is, what is something most people don't know about you?
That don't know about me. I think one of the most fun facts about me, I have a pet tortoise. His name is Tortilla. He lives in my backyard here in Arizona. He's in my will because he's going to outlive me forever. He's only 7. He's going to live till over 100, but super low maintenance. We love to travel. We kind of leave him by himself and he takes care of himself. So if anyone's looking for a low maintenance pet that outlives you, a tortoise is an awesome pet.
So he's in your will. Who is he going to?
My sister right now until we have kids.
Oh,
I love that.
I love that. Tortilla.
How big is your tortoise?
So right now he's about 50 pounds, but he can grow till over
big
100
tortoise.
pounds. So he's, like I said, he's only 7, but he's going to grow until he's past 20 years old. So he still has some growing to do.
So how many pounds do you say he'll grow
He's
to?
50. He's 50 and he could be, since he's a boy, he could be up to 120 pounds.
Holy moly.
Yeah, he's the second largest tortoise in the world. He's literally a zoo animal. You can go to the Phoenix Zoo and see that exact tortoise.
Wow. It had like transfer him by truck to the vet.
Seriously, yeah. When we move, we're gonna have to put him in the back of our truck or something.
Wow. Okay. So let's get into the Wealth Trifecta. What is it and why every entrepreneur or investor need to understand about it?
For sure. Like I was saying, I am a tax and business attorney, and my specialty is looking at a client's corporate structure and making sure they're set up best for both asset protection and tax savings. So when you come and work with me, and even though I'm based here in Phoenix, I would say only about 20% of my clients are based here in Phoenix. I have clients in every single state across the country. So it doesn't matter where you are, I can help you out. And what I'm doing for my clients is taking a comprehensive approach at their financial picture. And while I'm taking this comprehensive approach, I'm building their trifecta diagram. That trifecta is a visual representation of the things that they have going on in their life, as far as their estate plan, their operations, their assets. This visual representation, I love it for myself so I can see where a client's at and where I need to get them. And I like to offer recommendations to my clients too, that, hey, this is what your structure looks now. This is how it could look like in the future. And it's something that we get to build off of together as we're working throughout the years together. And it's nice to see that progression. And what it's doing is helping a client stay organized, because certain types of income is taxed differently than other types. Some income, you've got your self-employment tax added on. Other income is purely passive. These types of income, they're taxed differently, reported on different spots of your tax return. We don't want to muddy up your tax return. So we're going to keep these income streams separate for tax reporting purposes. And then it's also for asset protection purposes. We are never going to keep our rentals in the same entity we're running our operations out of. Think of a real estate agency. I would never recommend to a real estate agent or a property manager that they own their rental properties in the same entity they're running their operations out of. Because you can imagine a kid's goofing around in your office, they trip, fall, parents sue. That injury had nothing to do with your agency or your management company. So that's why we want to keep them separate, because our buildings, our assets, those slip and fall injuries can happen at any time. And we don't want those slip and falls to drag our whole operational side of things in as well. So this trifecta works great, and it helps clients stay organized, and it helps them. Anytime they add another business to their life, they're going to know exactly where to plug it in so they have the most protection and they're saving the most in taxes.
Interesting. Okay, so let's start with maybe the first part of the trifecta, which is the kind of like the business operation side or the active income side.
Absolutely.
So, for something like this, how should someone structure this if they are running like a real estate or service-based business?
Absolutely. Yeah. So our operational side, that is where our active earned income goes. This is our income subject to self-employment tax. This is us working for our money. So W-2 jobs and our active businesses. So property management company, real estate agency, a fix and flipper, a wholesaler, that's all going to be active income that's getting hit with that self-employment tax. Now, when my clients are first starting out in a business, I at least want them to start out with an LLC, and that is for asset protection. If you're out there running a business under your own name and your business causes injury, they're suing you because you're operating under your own name. And that means they can come at your house, the cash in the bank, all of your personal assets. So instead, I want my client to operate under an LLC because then they get that protection. Now, if their business gets sued, they're suing an LLC. Your personal assets are protected. So you get your corporate vow, an imaginary layer of protection that if something goes wrong, you're personally protected. But an LLC doesn't save on taxes. An LLC is for asset protection. So when my clients get to a certain point in their structure or their business, I want them to incorporate an S corporation into their business. So you can either convert your current LLC to an S corp. You remain an LLC, your name stays the same, you've got the same EIN. It's just now in the eyes of the IRS, you're taxed as an S corporation. And what that does is require you to take a minimum W-2 salary. That W-2 salary is now the only portion that gets hit with that extra self-employment tax. Let's just say that you don't have an S corp yet, and your net profits in your business are $100,000. That $100,000 is first getting hit with that self-employment tax, 15.3%. That's Social Security and Medicare. When you work a W-2, your employer is covering half of that. But when you're self-employed, you have to pay the full amount. So with a $100,000 net, you're getting hit with that 15.3%, and then you're paying taxes again at your tax bracket. Whereas once you have that S corp and you need to take that reasonable W-2 salary, using $100,000 net profits, you would want your W-2 to be about $40,000. So now only $40,000 gets hit with that extra tax instead of the full 100, and you're still taking out all 100K. It's just that bigger chunk, that 60K, you're just taxed at your tax bracket. So you're saving all of that in self-employment tax. Your W-2 will always be smaller than your distributions. When you're at that 100,000 mark, maybe it's about 40% is what that reasonable W-2 is. But that reasonable W-2, you are not comparing yourself to others in your industry. My clients who are doctors, they just assume they have to take a $100,000 W-2 or whatever is common in their industry. But it's not. You're basing it off your net, what you're actually taking out of your business. And when you start hitting 400,000 and above net, your W-2 will always be 30%. You make $1 million, your W-2 is 30%. You make $5 million, your W-2 is 30%. And we've created this payroll matrix where we are conservative enough that we're keeping the IRS happy, but we're aggressive enough that we're not paying too much into FICA. So our payroll matrix is tried and true. If anyone needs help determining what their W-2 salary needs to be, we've got that as a resource.
Love that. And so, you mentioned that, starting an LLC is probably the first step. And then eventually, as you start to build income and stuff, you move to an S corp. So is there a certain threshold, or when does it make sense to go from an LLC to an S corp?
Absolutely. There is a sweet spot because to have an S corporation, there's going to be some costs. First of all, you need to have a CPA who understands the S corp. You as the business owner, you need to be the quarterback of your team, but you need that support staff to help get you there. And the S corp requirements, there's a W-2, you have to be on payroll, you have to file an 1120S. You as the business owner do not want to stress about those things. You want a CPA getting that done on the back burner. So there's costs associated with having an S corporation. So I want to make sure my clients are saving more in taxes than they're spending to maintain this S corporation. That sweet spot is about $50,000. If you're in a partnership and getting a K1 of at least $50,000, or you're a single member and you're earning at least $50,000 in your business net after all your expenses, it makes sense to be an S corporation.
Got it. Okay, and so let's talk about the asset side. So once a business starts making money, it's time to build. How should investors hold real estate or other assets to maximize protection and tax advantages?
Absolutely. Yes. So that's really the goal that I have for my clients is that you need to be making as much as you can over on your left side where things are taxed worse because you get that extra self-employment tax, and pushing as much as you can over onto the right side where things are taxed best because this is passive income. You don't have that extra self-employment tax on there. So, and you don't want to go a bunch of money sitting in the S corp. Let's have that buy my rental property. That's a commingling issue. You never want an S corp to own a building. So, kind of that flow. You're going to be taking owner distributions from your S corporation, from your operational side, and you are taxed on that money if you take it out of your S corp or not. So, if you've got $50,000 sitting in your S corp, you're going to get taxed at the end of the year if you take that out or leave it in, because an S corp is pass through. Everything flows to your 1040. So you take an owner distribution. So send that money from the S corp back to your personal account. And now you want to be pushing that money into another LLC over on the right side, because rental property should always be owned by LLCs. If it's just you and your spouse, single member LLC. If you're with a partner, you've got a partnership LLC, but never C corps, never S corps over here. So you really need to make sure you've got your flow of money when you're taking money over here and over on the left side and pushing it over to your passive side. You got to get that flow right so people can't pierce your corporate veil. But when you're ready to start buying real estate, that's the entity that you use. It's going to be an LLC.
Got it. So what is a common misconception that you receive from your clients about the asset side that people tend to miss?
Yeah, I would say a common misconception. I honestly, I see a lot people's businesses, their S corporations owning real estate, and kind of how I described that before. If you have a rental property, that has nothing to do with your operational side of things. So you don't want your S corp buying a building. One, an S corp saves on self-employment tax. So if you stick your rental property in an S corp, now you're subjecting passive income to self-employment tax. Because if you got money running through an S corp, you have to take a W-2. So my clients often think, hey, I'm going to have my S corp buy the building because now I get to save. I'm netting greater than $50,000 in my rental property. I need to have an S corporation. No, that actually subjects your rental income to more taxes because now you have to file a W-2 from that entity. So S corporations don't save on taxes when it comes to the rental side. You're already getting the best taxes there. It's passive income, no self-employment tax.
And so when I'm just kind of curious now too. So like if say for example, I have my left side, which is my active income and my business on my S corp.
Mm-hmm.
And then on the right side is all my assets. And these, you said that these are like passive investments. So these are like long-term rentals and things like that. And so what's, does it change if say, for example, the asset class is different? Like there's like the short-term rental loophole and all that stuff. So how does that kind of fit into the whole picture?
Yeah, that actually brings up a really good misconception as well. So no, if you have a rental property, whether it's commercial, residential, an Airbnb, and even if you are super active on that property, you're managing it, you have material participation, it is still passive income, which is good. You want the IRS to classify your rental income as passive because, like I said, it's tax better. But when you qualify for something like the short-term rental loophole, real estate professional loophole, that's just your ability to unlock those passive losses to offset your operational gains. Because typically you can only use passive losses to offset passive gains. You can't use your real estate losses to offset your W-2 or your S corporation. But when you qualify for one of those loopholes, it's a way for you to unlock those passive losses to offset any of your income.
Gotcha. Okay, cool. All right. Well, I guess we'll move to the last piece here, which is the foundation, or which is like the trust and legacy planning.
For sure.
And so, you know, you kind of talked about this. The left side is the active, the right side is the assets, and then at the bottom of all this, or the foundation, is the trust.
Right.
And so, why is it critical to have a trust, even though, even if people don't consider themselves rich?
Right, exactly. Yeah. So a trust and estate plan, it makes sense for everybody. So without a trust, you and your spouse pass away, your whole entire estate goes to probate, which means it's up to your state and the courts to decide what happens to your things. It's a long process. I just got off the call with a client who said that they've been in probate for 6 years after their parents died. So it is a long process. And just imagine that heartache and headache that causes all those years. It's expensive, which eats into your loved one's inheritance. Plus, most of us are paying state income tax our whole life. We don't want to die and give more to the states. And it's public, which means anybody could look up your case number and see what you died with. So my clients want that peace of mind that they're building up their wealth, their legacy. They want to decide what happens to their things, not leave it up to the state. Their families want that peace of mind because let's be honest, we're going to be dead. It's not us dealing with it. It's our families. So they want that peace of mind that they don't have to hire attorneys to fight probate court, and it's keeping everything private. So that trust is you coming in for a seamless plan. You get to choose exactly who takes over your estate at what time, and if there's any restrictions on that. Because if you have young ones, you do not want your 18-year-old receiving their whole entire inheritance at once. They're going to go buy Ferraris, they're going to blow it, it's going to mess them up financially for the rest of their lives. So that trust is another kind of fun way you can control your kids from the grave a little bit. You can make it silly, you can make it fun, but it's important, even if you're young, because like I said, if all you have is cash in the bank, you have a house, you don't need a lot of assets for it to make sense, because even if you have a low amount of assets, your family will still end up in probate. And we have no idea when we're going to pass away, but it's inevitable. It's the one thing that we know. We are all going to die one day, and we want that protection and safety for our family and our estate.
Yeah, and you talked about the whole I've had this debate with a lot of people of like, okay, are you going to leave a lot of your wealth to your kids? And, how does that look? Because you're right, like you don't want to give it to them all at 18 because maybe
Right.
they're just not mature enough to handle all that wealth.
Right.
And so what's, you know, is there like a structure or common structure that you've seen? Like I've heard ones where it's like, okay, this amount will go to you when you're 30, but
Mm-hmm.
you also have to pass these like check marks, right? It's like you have to have
Yeah.
a job and you
Right.
have to not be a bum or whatever it is,
Right.
right? And
Exactly.
so is there a certain like structure that you recommend for kids or
Yeah.
for transfer of wealth?
For sure. So my favorite is staging it out. And I like to start at the age of 25. Again, research shows that's when your frontal lobe fully develops, is 25 years old. So I like to stage that out. Let's give the first chunk to our kids at 25, the next chunk at 30, finish it off at 35. So I like the stages, but you can still provide funding for your children for major life events and milestones before they turn 25. If you want to pay for their schooling, you can give them some funds for that. You want to pay for their first wedding, buy their first car. So even though they aren't receiving their first big chunks until later in life, we can still make sure that they're taken care of before they get to those ages. And some common restrictions too: drug and alcohol abuse, gambling abuse. So basically, you're leaving that up to your trustee. If they have any indication your kids are suffering from these addictions, that trustee can hold off in giving them their inheritance until they're overcoming these issues. Because you don't want your legacy to be, blown on their substance abuses and things like that too. So there are a lot of creative ways that I come up with my clients to make sure that that gets done.
Yeah, I love that. I actually have that one in my will and trust. I didn't know that was like a common thing, actually. Yeah, I think like if my kids are convicted of some kind of crime or have some addiction, then it goes
Yeah.
to my trustee to basically their own judgment on when the funds are released to them. That's really cool.
Exactly. And you want a trustee who kind of shares the same values of you, and be open and honest and have those conversations with your trustee, because a gambling addiction could look different to one person than another. So you want to be open and honest with the people that you're involving in your trust.
I have another question too. So, I learned, I think Bill Gates is giving their kids $10 million max each.
Mm-hmm.
And, for how much he's worth, right? 10
Right.
million is kind of a drop in the bucket. And I'm like actually really curious, like how do wealthy people decide the max amount of to their kids? And in my head, I feel like I have an imagination that like, Bill Gates sent a bunch of people to do some research and be like, what's the amount to not screw up your kids?
Yes.
Do you think that exists? Is that a thing?
I totally, yeah. And I'm sure he's worked with CPAs, financial advisors, attorneys to figure out those numbers. And I'm sure a big consideration is that federal estate tax exemption. For an individual, you can gift up to $15 million at your death without being hit with any federal estate tax. If you gift above 15 million, you're going to be hit with some federal estate taxes there. For spouses, you get 30 million, which is another important piece of having that revocable living trust is you need that in order to preserve that full 30 million. So we can put some special language in there to make sure that your estate's going to be exempt up to 30 million. So I'm sure that he took that into consideration as well.
Oh yeah, that's so fascinating. And it's just like for me, I was like, well, then what's the point of actually earning so much money if you can only be like, this is the amount of money that actually makes most sense to give to your kids, and at some point it just becomes toxic, right? Or they don't even know how to manage it.
Yeah, and it's kind of a balancing act too, because sometimes my clients will say, okay, I'm going to give all my money, give all my rental properties and businesses to my kids during their lifetime. I never want my clients to gift their children businesses, real estate properties during their lifetime. There are certain strategies where maybe it makes sense, but you're messing with your child's basis at that kind of juncture. If let's say you purchased a piece of real estate for $100,000 and now it's worth $1 million. If you gift your child that piece of property during your lifetime, they take your basis. So now they have $100,000 basis. Whereas if you give it to them through your revocable living trust, you're preserving that stepped up basis. If your child takes that upon your death during your trust, they take that property at $1 million, which means that they could sell that property the day after your death and not pay a dime in capital gains. I actually had a client here in Scottsdale. Her mom left her a property. It was worth $2.4 million. She received it through her mom's trust, sold that property for $2.4 million, and did not pay a dime in capital gains. So super powerful, that stepped up basis.
I love that.
Is that so? And that is because it was through the vehicle of a revocable trust. Like if it was any other way, then you would not get that benefit. Is that
not
correct?
as easy? Maybe if you find an attorney and fight that, but yeah, the trust is the ultimate preservation of that stepped up basis.
Mm-hmm.
Okay. Well, let's head back to the trifecta and let's tie it all together. Can you walk us through how the income flows from a business to an investment and into a trust in a way that reduces tax and protects assets?
Absolutely. Yeah, I don't like the loaning structure. Let's loan money from one company to the other. That gets very complicated. I haven't met a CPA who loves to do that. And the IRS, they see through those kinds of things. So starting with that foundation, your trust. And your trust won't have a bank account during your lifetime. That happens after you die. So your trust is basically just you. You during your lifetime, your trust owning things is the same thing as you owning things. So starting with your trust, your personal bank account. You as the business owner can always put more money into your businesses. You just need to mark that in the books properly. So when you're sending money from your personal bank account into your S corporation, that's an owner capital contribution. And I never want you guys to be keeping a ton of cash in your operational businesses, because your business is out there operating. If it causes injury and your business gets sued, they're coming at the cash in your bank account. And there's a ton in there. You don't want them to have access to that. So I always recommend keep maybe just a couple months of operations and expenses sitting in your operational entity. When you push money back out to yourself and you want to go push that into investments, it's simply just a bank transfer from your S corporation bank account to your personal account. You mark that in your books as an owner distribution. There's no double taxation or anything like that, because that money, you've already paid taxes on it. So now that money is sitting in your personal bank account again. Now, into your LLC over on your asset side, you're going to make another owner capital contribution into that LLC and then go do your repairs, your construction, whatever you got to do over there. So that's how I like that flow of money to work, through owner capital contributions and owner distributions.
And so once, I guess, kind of following that flow of money, once your properties start making returns, right? You collect rent and you get cash flow. Where does that money go? Does it
Yeah.
stay in the LLC or?
Yeah, so kind of depending on your structure, eventually my real estate clients get to the structure where they want a holding company, a Wyoming COPE charging order protective entity. That's the holding company. Wyoming has really neat statute or LLC statute. So what an LLC is doing is protecting you from your asset. Somebody slips and falls on your rental property, they're not suing you, they're suing your LLC. But that asset protection does not work both ways. If you're texting and driving, running a stop sign, and you hit somebody, now you're being personally sued. That LLC is not protecting your rental property. They can make you liquidate that property. That asset protection does not go both ways. But Wyoming has specific language in their LLC statute that says, if someone has a personal judgment against them, we're not going to let them break into our LLCs. So eventually that structure will be your trust owns a Wyoming LLC 100%, and then Wyoming owns all of your state-specific LLCs. Wyoming never owns properties. It just owns other LLCs. That is a good storage of excess business cash. So you would only be keeping a couple months of operations and expenses up top in your property owning LLCs. You're making owner distributions back into Wyoming. Keep it there where it's safe. So now if a major expense comes up on one of your rentals, you can easily make that transfer there, and all that cash is protected from you personally as well.
Okay. So that's kind of like your safety deposit box type of thing with your holding company.
Right.
So from what I'm hearing is that that money can't be touched if I get sued personally or anything like that.
Exactly.
Interesting. Okay. Cool. Well, this was very, very helpful. As we mentioned earlier to you, Ashley, you were at our anti-conference conference and talking about the Wealth Trifecta. And, we got a lot of positive feedback from your presentation. And that's why we wanted to bring you onto the podcast to just continue it. So I really appreciate you breaking down the Wealth Trifecta. And I think the point that you made where it's, building wealth is about just investing early and being consistent about it. I think that's, a huge, huge piece of advice for everyone. And this trifecta can help support that. And so I think those are really good takeaways. And the compounding does matter. And it is the long game. It is not a get rich overnight situation.
Absolutely. Yep. Everybody be maxing out your Roth IRAs and your HSAs. You will be thanking yourself in the future. I promise.
Yeah, I love that. And I think during the anti-conference, someone said that you sat down with them, outside of outside of your session to kind of walk through like their particular situation. So I love how, dedicated and, just willing to give advice. I definitely, so I really appreciate that.
Yeah, of course. I love this stuff, seriously. And I love teaching, and I'm a real estate investor myself. So if you come to me, I'm teaching you what I do, and I'm doing what I teach. And I really love it.
I love that. That's awesome. And so for our listeners who want to get to know you more, how can they do that?
Yeah, the best way, I am super responsive by email, and I'm not one of those stickler attorneys that are charging by every single email and things like that. So please always feel free to reach out to me. The best way will be email. My email is ashley.burr@KKOSlawyers.com.
And that's BURR.
Yeah.
BURR. Yep.
Just random, Ashley. Did you ever do the Burr method?
No, but I do know it. I haven't done it myself, but I have many clients who do, and I help support them through that. But yeah, I love the Burr method.
Oh, I love that. That was such a dad joke.
I had to. That's literally every time I see your last name, I'm just thinking about Burrs. All right. Well, again, thank you, Ashley, for your time today. If this episode resonated, share it with a friend, leave us a review so we can reach more people. If you didn't like the episode, forget about it. And so we'll see you next time for the SARE Ladies Podcast.
Bye, friends.
Bye.
Thanks for tuning in to this episode of the SARE Ladies Podcast. If you enjoyed the conversation, make sure to follow, share, and leave us a review. It helps more women in real estate find this community. And don't forget to connect with us at sareladies.com for more resources, stories, and support on your investing journey. Until next time, keep building, keep learning, and keep breaking barriers.